Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Matt Lewis, Head of ETF Implementation at American Century. We're going to discuss liquidity in the ETF market as well as what you need to know about trading newer and lower volume ETFs. Matt, it's great to have you with us. Welcome to TradeTalks.
Thank you, Jill, for having us.
ETF space is big and it's only getting bigger. Give us a high-level overview of the ETF capital markets.
Sure, ETF capital markets is a critical role that's with ETF issuers that are serious about being in the ETF space. There's three distinct things that I look at when I think about ETF capital markets, and that's really we engage very heavily with the ETF liquidity providers, be it the authorized participant, the market makers, as well as I have a team of people that monitor our products, make sure that they're trading efficiently. So when investors go to buy and sell or trade our products, they know that are going to be able to get an efficient price. The third thing is that we guide clients, investors, advisors through the ETF capital market ecosystem, like how to achieve best execution, things to think about when they're implementing their strategy into our ETFs.
So what are those different layers of ETF liquidity?
Sure, I mean, I think about it as a triangle, or call it an iceberg, where there's three layers of liquidity. There's the top layer, that iceberg is sticking out. It's a small portion of the iceberg, where that's what you're seeing on screen. It's what's been traded. It's not what could be traded. And then there's like the second layer, sort of right underneath that, where there's liquidity providers, be it ETF market makers, that are there, that are willing to make a trade for larger sizes. It's sort of, and there's ways to access that liquidity instead of just going out to the open markets. You can certainly do that. I always recommend a limit order when you're doing that, but there's other ways that you can access that to, sort of pull them out and say, yes, I will provide you an efficient price for a larger trade. And then the third layer is the primary markets. That's the creation, redemption of the ETF. That's where authorized participants will create ETF shares for the demand, if there's demand for that ETF in the marketplace, but there's not enough sort of natural liquidity for it on the exchange.
So then what's the difference between a market maker and an authorized participant?
Sure, I see this a lot where I see headlines say authorized participants putting out quotes for an ETF. In reality, they are, but really there's a distinct role is that they are an entity that is able to create and redeem the ETF. When they're putting out quotes in the market, they are now an ETF market maker, where they're willing to put up quotes, take on risk and so forth to provide investors the ability to buy and sell those ETFs shares over the exchange.
So when you work with institutional block desks, is that how you're able to find those trades that might not necessarily be on the quote? You know what your clients want, you know what the other side is looking for. So these authorized participants, is that how they're working with the block desks?
Sure. Actually, a block desk is there for, it's for advisors, right? Mostly. I mean, all investors too, but mostly advisors, where the advisors are allocating and buying and selling for their client accounts. They're usually on a custodial platform, and those custodial platforms over time have put a lot of resources into building out these institutional block desks to be there as a resource to help the advisor achieve efficient execution for the larger allocations, even the smaller trades that they want to do. And when I talk to advisors, I like to give them, that encouragement to reach out to the block desk, build a relationship with them, understand what it takes to access them, because I think that they have direct access to the ETF liquidity providers, the market makers, and they will put trades out, a request for quote, and have ETF market makers compete for that. And that competition leads to more efficient pricing for the advisor.
It almost sounds like institutional block desks on the equity side, having a more intimate relationship with those larger desks and being able to find that best execution and working those trades.
For sure, they have great relationships with the ETF liquidity providers. Again, these were built out over time, and I've seen that they are really a strength within the advisor custodial platform to really help them achieve best execution. When you think about a lower volume ETF, right, and something that, we have a product listed here on the Nasdaq called Short Duration Strategic Income, SDSI is the ticker. Relatively new product. It's been in mutual fund form for some time, but advisors were asking us to bring it out in ETF form. We wanted to bring it out in ETF form because it's been a successful product of a rotation strategy across multiple fixed income arenas, be it corporates, be it collateralized debt, emerging market bonds, treasuries, and so forth. Produces a really high degree of current income and has a potential to, have some total return with market dislocations that our portfolio managers see. So, but back to, it's a lower volume ETF. I wouldn't say it's a lower liquid ETF. It's a lower volume because it's the volume that's traded on the exchange. But when advisors want to come and purchase that and allocate to that for their clients, they should go through an institutional block desk because those ETF liquidity providers, be it market makers, are there willing to provide a trade, a larger quote for a larger size, and fill that trade for the advisor, and then take that and manage the risk themselves, be it through the creation and redemption process, creation in this case if they're buying, and or they might be able to access the shares somewhere else within the market. So that's just the efficiency of using an institutional block desk for advisors.
But I think it's an important distinction that you make, the difference between volume and liquidity. If you're just to punch that up on the screen and you get, the best quote that's out there, it looks like it's very dislocated because you don't see much volume and then you see the price discrepancies and so forth. So I think it's important for investors to understand that there is a distinction between liquidity and volume.
Absolutely. I mean, ETFs, the volume of an ETF or the liquidity of an ETF, the basis of that liquidity is the underlying securities that ETF holds, because it's that third layer of liquidity. It's that creation redemption mechanism that authorized participants, market makers can access to create more shares, to be able to execute larger trades in the market. So, and then, if you are an investor that, you only have access to, putting market trades up, or I always say put a limit order on it. You see a price, you like that price. So make sure you protect that price by putting a limit order on it. It's just an extra step that somebody should take, but it really would benefit them because market makers will see that and they want to execute that, and they'll see that it's a limit order, and if they find that's an efficient price, they'll fill that order for you.
All right, Matt, we appreciate the insight. Thanks for joining us on Trade Talks.
Thank you.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.